If you're new to the world of investing or just looking to deepen your understanding of the financial landscape, you've come to the right place. In this comprehensive guide, we will delve into the investment alphabet, covering essential terms and concepts that form the bedrock of successful investing. A. Assets, the pillars of a company's worth. To kick things off, let's talk about A for assets. When it comes to assessing a company's value, assets play a pivotal role. Assets encompass everything a company owns or controls, including tangible items like cash, buildings, machinery, and inventory, as well as intangible assets like patents and trademarks. Understanding a company's assets is crucial as they provide insights into its financial health, solvency, and growth potential. For investors, analyzing a company's asset composition is like peering into its DNA to gauge its resilience and ability to create value in the long run. B. Bonds, the bedrock of fixed-income investments. Next up, B stands for bonds. Bonds are debt securities issued by governments, municipalities, or corporations to raise funds. When you invest in a bond, you are essentially lending money to the issuer, who agrees to pay you periodic interest and return the principal amount upon maturity. Bonds are a popular choice for risk-averse investors seeking a predictable income stream, as they are considered more stable than stocks. Understanding the intricacies of bonds, such as credit ratings, interest rates, and maturities, is crucial for building a balanced investment portfolio. C. Compounding, the magical snowball effect. Now let's talk about the magic of C for compounding. It's a concept that can work wonders for your investments over time. Picture this. You invest a sum of money, and as time goes by, you not only earn returns on your original investment, but also on the accumulated returns from previous periods. This snowball effect is the power of compounding in action. The earlier you start investing, the more time your investments have to grow through compounding, making it a key principle for successful long-term investing. D. Diversification. Don't put all your eggs in one basket. D is for diversification. You've probably heard the saying, "Don't put all your eggs in one basket." And that's precisely what diversification is all about. Instead of focusing on a single investment, diversification involves spreading your money across various asset classes, industries, and geographic regions. By diversifying, you can mitigate the impact of a single investment's poor performance and reduce the overall risk in your portfolio. This approach ensures that even if one sector falters, other investments may still thrive, providing a more balanced and resilient investment strategy. E. Equity, owning a piece of the puzzle. Next up, let's explore E for equity. In the stock market, equity represents ownership in a company. When you buy shares of a company's stock, you become a shareholder, which means you have a claim on its assets and earnings. Equity investments can offer considerable growth potential, but they also carry higher risk compared to bonds. As an investor, understanding equity valuation, market trends, and a company's competitive advantage can help you make informed decisions while navigating the dynamic world of stocks. F. Fundamental analysis, digging into the financial foundations. F represents fundamental analysis, a cornerstone of investing. This involves evaluating a company's financial health by examining its revenue, earnings, expenses, and other critical indicators. By studying a company's financial statements and understanding its business model, industry position, and growth prospects, you can estimate its intrinsic value and identify potential investment opportunities. Fundamental analysis allows you to distinguish between overvalued and undervalued stocks, guiding you towards sound investment choices. G. Growth stocks, the trailblazers of the market. G stands for growth stocks. These are shares of companies that are expected to grow at an above-average rate compared to their peers or the overall market. Growth companies are often at the forefront of innovation and expansion, reinvesting their earnings to fuel further development. Investing in growth stocks can be rewarding, but it also comes with increased volatility and a higher level of risk. As an investor, striking a balance between growth stocks and more stable assets in your portfolio is crucial to manage risk effectively. High-frequency trading, the speedy world of algorithmic traders. Moving on to H, we have high-frequency trading, HFT, a fascinating phenomenon that has revolutionized the financial markets. HFT involves using powerful computers and sophisticated algorithms to execute a large number of trades in fractions of a second. These lightning-fast transactions can make or break profits for HFT firms, and they play a significant role in shaping market dynamics. The rise of HFT has sparked debates about market efficiency, fairness, and potential risks. For the individual investor, understanding HFT's impact on market liquidity and price movements can help navigate market fluctuations with greater awareness. I. Index, benchmarking the market. I is for index, a critical tool for investors and analysts alike. An index is a group of stocks representing a particular market, sector, or industry. It serves as a benchmark, allowing investors to compare their portfolio performance to the overall market or specific segments. The most well-known indices include the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite. Tracking indices and understanding their constituents can provide insights into market trends and help investors make informed decisions. J for junk bonds, high risk, high reward. J represents junk bonds, also known as high-yield bonds. These are debt securities issued by companies or governments with below investment-grade credit ratings, indicating a higher risk of default. To compensate for the increased risk, junk bonds offer higher interest rates compared to investment-grade bonds. For some investors, the allure of potentially high returns makes junk bonds attractive, but they come with a caveat: higher risk and greater sensitivity to economic downturns. K. Key Performance Indicators, KPIs. Unveiling the company's scorecard. Next on our list is K for Key Performance Indicators. KPIs are specific metrics that companies use to measure their performance and progress toward their goals. These indicators vary depending on the industry and company objectives, but may include metrics like revenue growth, profit margins, customer acquisition costs, and customer retention rates. As an investor, understanding a company's KPIs can help you assess its operational efficiency, management effectiveness, and potential for long-term success. L. Liquidity, the lifeblood of the market. Moving along, L stands for liquidity. In the financial markets, liquidity refers to how easily an asset can be bought or sold without significantly impacting its price. High liquidity assets are readily traded, allowing investors to enter and exit positions with minimal slippage. On the other hand, low liquidity assets may experience larger price swings due to fewer buyers and sellers. For investors, understanding liquidity is essential for executing trades efficiently and managing risk effectively. Market capitalization, sizing up companies. M is for market capitalization, a fundamental metric used to assess a company's size and value in the stock market. Market cap is calculated by multiplying the stock's current price by the total number of outstanding shares. Companies are often classified into different categories based on their market capitalization, such as large cap, mid cap, and small cap. Market cap is crucial for building diversified portfolios, as different market cap segments offer varying growth potential and risk profiles. N. Nasdaq, the tech titan exchange. N represents the Nasdaq, an iconic stock exchange known for its focus on technology companies. Founded in 1971, the Nasdaq has become a symbol of innovation, hosting many of the world's largest tech giants. Its electronic trading platform and reputation as a hub for growth companies make it a favorite among investors seeking exposure to cutting-edge industries. The Nasdaq Composite Index, a benchmark of tech-heavy stocks, serves as a barometer of the technology sector's performance. O. Options, the versatile derivatives. O stands for options, fascinating financial instruments that grant investors the right, but not the obligation, to buy or sell an asset at a predetermined price within a specified time frame. Options are classified into two categories: call options, which provide the right to buy the underlying asset, and put options, which provide the right to sell the underlying asset. Options are commonly used for hedging, speculation, and generating income, but they come with unique risks that require a deep understanding before trading. PERT, or PE ratio, evaluating a stock's price tag. Next, P is for price-to-earnings ratio, often referred to as the PE ratio. This essential valuation metric compares a company's stock price to its earnings per share. The PE ratio helps investors assess whether a stock is relatively expensive or inexpensive compared to its earnings. A high P/E ratio may suggest the market has high expectations for a company's future growth, while a low P/E ratio may indicate undervaluation. Analyzing the P/E ratio alongside other fundamental factors can provide a comprehensive view of a stock's investment potential. Q. Quantitative easing, unconventional monetary policy. Q represents quantitative easing, QE, a monetary policy used by central banks to stimulate economic growth when traditional tools like interest rate adjustments have limited impact. In QE, central banks buy financial assets like government bonds and mortgage-backed securities from commercial banks, injecting money into the economy. By increasing the money supply, QE aims to lower interest rates, boost lending, and spur economic activity. While QE can help support financial markets during times of crisis, its long-term effects on inflation and asset prices remain subjects of debate among economists. R. Risk management, safeguarding your investments. R represents risk management, a crucial aspect of successful investing. Risk management involves identifying, assessing, and mitigating potential risks in your investment portfolio. It's a proactive approach to safeguarding your capital and ensuring that your investments align with your financial goals and risk tolerance. Diversification, asset allocation, and periodic portfolio rebalancing are common risk management techniques that can help you navigate market uncertainties and stay on track toward your investment objectives. S. Stock split, dividing the pie. S is for stock split. This corporate action occurs when a company divides its existing shares into multiple shares, effectively lowering the stock price while increasing the number of outstanding shares. For example, in a 2-for-1 stock split, each shareholder receives 2 shares for every 1 share they previously owned, effectively cutting the stock price in half. Stock splits are generally cosmetic in nature and don't impact a company's overall value or market capitalization. They are often implemented to make shares more affordable to a broader range of investors or enhance stock liquidity. T. Technical analysis, decoding market patterns. T stands for technical analysis, a popular method of evaluating investments based on historical market data and price patterns. Unlike fundamental analysis, which focuses on a company's financial health and intrinsic value, technical analysis studies past market performance to predict future price movements. Chart patterns, trend lines, and technical indicators like moving averages and relative strength index, RSI, are common tools used in technical analysis. While some investors swear by technical analysis for identifying entry and exit points, others view it with skepticism, emphasizing the importance of a balanced approach to investment research. U. Underlying asset, the foundation of derivatives. U represents the underlying asset, a critical concept in the world of derivatives. Derivatives, such as options and futures, derive their value from an underlying asset, which can be stocks, bonds, commodities, or even indices. For example, an option contract on a specific stock would have the stock as its underlying asset. Understanding the relationship between derivatives and their underlying assets is vital for successful options and futures trading. V. Volatility, riding the market roller coaster. Next up, V is for volatility, a characteristic that defines market fluctuations and price swings. Volatility measures the degree of price change an asset experiences over a given period. Assets with high volatility tend to have greater price swings, presenting both opportunities and risks for investors. While volatility can create attractive buying opportunities, it also requires careful risk management to avoid potential losses. As an investor, understanding the factors influencing volatility and its implications for different asset classes can help you make more informed decisions and stay resilient during turbulent market conditions. W. Warren Buffett, the Oracle of Omaha. Now W is for Warren Buffett, an iconic figure in the world of investing. Often referred to as the Oracle of Omaha, Warren Buffett is one of the most successful and revered investors in history. He built his fortune through a patient and disciplined value investing approach, focusing on the long-term intrinsic value of companies rather than short-term market fluctuations. Buffett's investment principles, such as buying wonderful businesses at fair prices and be greedy when others are fearful, have inspired generations of investors and serve as valuable lessons in the art of investing. X. Xenocurrency, unearthing a rare gem. Okay, X is indeed a challenging one. Let's talk about xenocurrency, a term that refers to a currency that is not from the country where it is used as legal tender. While not directly related to the stock market, understanding the concept of xenocurrency can be intriguing, especially in the context of international trade, foreign exchange markets, and global investment opportunities. Y. Yield, harvesting returns. Y stands for yield, a fundamental concept in investing. Yield represents the income generated from an investment, typically expressed as a percentage of the investment's cost. For example, the dividend yield of a stock is calculated by dividing its annual dividends per share by the stock's current price. Understanding yield is essential for income-seeking investors, as it helps them gauge the potential returns from various investment options and make informed decisions based on their income needs and risk appetite. Z. Zero coupon bonds, the silent interest bearers. Finally, Z is for zero coupon bonds. These are unique bonds that don't pay regular interest like traditional bonds. Instead, they are sold at a discount to their face value and do not make periodic interest payments. However, upon maturity, zero coupon bondholders receive the full face value, which represents the interest earned over the bond's life. Zero coupon bonds can be attractive for investors seeking a predictable lump sum payout at a future date, but they also come with the potential drawback of being sensitive to changes in interest rates. Remember, investing is both an art and a science, requiring a curious mind, continuous learning, and disciplined decision-making. As you embark on your investment journey, don't hesitate to explore, seek knowledge, and embrace the unpredictability of the market. Each investment decision is an opportunity to grow your wealth, make a positive impact, and achieve your financial goals. Whether you're a seasoned investor or just starting, the key to success lies in maintaining a balanced approach, diversifying your portfolio, and staying informed about global economic trends. Embrace the challenges, learn from your experiences, and remain steadfast in your pursuit of financial prosperity. Thank you for joining us on this educational adventure. If you found this guide helpful, don't forget to share it with others and stay tuned for more insightful content. Happy investing, and may your financial journey be filled with growth, wisdom, and prosperity.